What's going on? Alex here, and today I'm bringing you the 7 deadly sins of S corporations. We deal with a lot of S corporations in my practice, and while they, in many cases, provide great tax benefits, there are also a number of blunders that we come across where new clients have an S-Corp, they come to us, and we discover that they've committed one or more of the 7 deadly sins. And what that results in typically is taxes, penalties, interest, and costs of remedying all this and fixing the financials and bringing everything up to date so that moving forward, you can have some smooth sailing with your S-Corp. We've done a lot of these fix-up jobs for clients, and it takes a while, it's expensive, it's no fun. That's why I'm putting together a list of issues for you to avoid with your S-Corp so that your life is easy and wonderful. All right, so let's get started. The 7 deadly sins of S corporations. This is what not to do. And of course, it's in an Excel spreadsheet because how else would I do it? Alrighty. Now, the first deadly sin is failure to take reasonable compensation. What does all that mean? Well, when you have an S-Corp, there's really 2 main methods of taking funds out of the S-Corp, right? You can take wages, also known as salary, also known as W-2 income, and you can take what are known as distributions. All right. The wages have a disadvantage in that they're subject to payroll taxes, namely Social Security and Medicare. Those are the big ones. And when you take the wages, you're paying the employer portion of Social Security and Medicare and the employee portion of Social Security and Medicare. On the other hand, if you were to take distributions out of the S corporation, then those are not subject to Social Security and Medicare. So in many cases, you'll have S corp owners that say, look, I made $1 million this year, and I'm going to take out $1 million as solely distributions because that's advantageous from a tax perspective, meaning they take no wages, no W-2 income. That's a huge problem because the IRS and the tax code have both made it very clear that reasonable compensation must be taken in the form of W-2 wages and or salary. So then S-Corp owners say, okay, well, if you need me to take some salary, then fine. I'll take $1 million out of my S-Corp, $10,000 will be salary / wages, and the rest will be distributions, $990,000. That doesn't work either because in many cases, that tiny amount of reasonable compensation doesn't meet the criteria for the reasonable part. And what can happen is the IRS can go back and reclassify the distributions that you took, which were advantageous from a tax perspective, to salary. And then you're dealing with delinquent payroll taxes, penalties, interest. It gets ugly very quickly in that scenario. So that's why reasonable compensation must be taken. The issue is that there is no guidebook that we can open up that has reasonable compensation for an attorney, for a doctor, for a graphic designer, for a photographer. We need to look at the facts and circumstances and determine what reasonable comp should be in every scenario. And with that, there are additional costs involved, additional time necessary to put that analysis together. So in many cases, we have clients that come into our practice who are new, who just chose a number out of the blue, and they take $1 million out of their S-Corp and they call $100,000 reasonable. And they take that out as wages. Is that enough? Is it not enough? That's the question. And that's when we take a look at each respective scenario, make an assessment as to what reasonable comp should be. And the issue we're looking to avoid is the reclassification by the IRS. Now, I have a few videos about S corporations and I go into reasonable compensation in depth. But if you have an S-Corp and you're taking a significant amount of funds out and the salary component is little to nothing, then you may have a problem with the first deadly sin of S corporations. So watch out for that. If you're taking funds out of your S-Corp, some of it can be salary, some of it can be distributions, but there needs to be a balance. All right, so that is reasonable compensation. Next, we have making the S corporation election prematurely. With great tax benefit come great responsibilities. And with an S-Corp, that's certainly the case. You can save significant amount in taxes by making the S-Corp election, but it brings along with it administrative burdens that must be taken care of. And if you don't, you'll end up way behind where you would have been if you avoided this issue altogether. Some of those administrative burdens are extra tax returns. The S-Corp needs to file its own tax returns in addition to your personal returns on an annual basis. Then you have accounting and bookkeeping. Typically, if you have an S-Corp, it's necessary to have at least some rudimentary bookkeeping in place so that you know your numbers. So you can determine what's coming in, what's going out, what's wages, what's distributions, and keep track of everything. Aside from that, we have the reasonable comp analysis, which typically goes into it as well. We have estimated payment calculations because the S-Corp is a flow-through entity, so the income is not taxed typically at the S-Corp level, it's taxed at the personal level. So you may need to make estimated payments. You got to have the payroll going throughout the year. And there's usually some planning up front to allow our clients to understand what the S-Corp election even entails and whether it makes sense in their situation. So there's a lot that goes along with it. And what I typically see is someone has an idea for a business. They go online, they start Googling, and the first website they come across says, when you have a business, you need to form an LLC and you need to make the S-Corp election. In reading those two things, this person will do just that. On day one, form an LLC, they have the S-Corp election, they have no idea what any of that entails. And then we get the phone call. Hey, my name is Jim. I just started my LLC. I made the S-Corp election, and I want to know what all of this means. And we asked them, what are your expectations with regard to the income for this business for, let's say, the first year? And they'll say, well, I don't expect to make any money in the first year. Great. So at that point, we already have the LLC, we already have the S-Corp in place, and all of those administrative burdens that I just talked about come into play whether you like it or not, because you've crossed that threshold. The typical guideline that we give to clients that are inquiring about the S election is that it typically starts to pay for itself at $100,000 to $150,000 of income or higher before the owner pays themselves. That's when the tax savings, the potential tax savings, begins to exceed the additional administrative costs involved in maintaining the S election. Because you don't want to save $2,000 in taxes and then pay an additional $4,000 in tax filing fees, tax consultation fees, and so forth, right? You'll end up $2,000 behind. Where you want to end up is ahead of the game in that you may save $2,000 in taxes and it only costs you $1,000 to get there. Okay, that's a win. But we see all the time that the S election is made way prematurely. Even if the business is expecting a few thousand in income here and there, maybe even $20,000 to $50,000, it's still likely too early to make the S election. You can, in many cases, still accomplish everything you're looking to accomplish with a single-member LLC, a multi-member LLC, what have you, before taking the plunge into the S election. You don't need to do it on day one. So to be very clear, you can have an LLC that's operating for 10 years and then decide that you want to make the S election in year 11. That's perfectly fine. So with that, the second deadly sin of S corporations is making the election too early and not fully understanding what it entails. There's a lot that goes along with it. All right. Number 3. Disproportionate distributions. What does that mean? Now, let's say a business is structured as a partnership, right? You have a multi-member LLC. You have 2 owners. One takes $20,000 out of the business. The other takes $30,000. Another one takes $5,000. And the second one takes $7,000. There's nothing wrong with that. In a partnership, as long as you're following the partnership agreement, you're all good. It's kosher. But one of the main stipulations with the S election is that the distributions must be proportionate to the ownership percentage. A lot of S-Corp owners overlook this rule altogether, and you'll have one owner, owner A, take 10,000 in distributions, and you have owner B take 100,000 in distributions. That can blow up the S election altogether. So in that case, you may think you had an S corporation, but it actually was terminated last year because of disproportionate distributions. A lot of business owners are not aware of this rule at all. So basically what it means is that if you have 50-50 owners, the distributions also need to be 50-50. Now, I'm often asked, why does the IRS care whether one shareholder takes different distributions than another? Who cares? Well, one of the fundamental requirements for an S-Corp is that there's one class of shares. All right, so you can't have common shares A, common shares B, and so forth, and different voting rights and distribution rights and so forth. It has to be one class. So when you have disproportionate distributions, it gives the appearance of a second class of shares, meaning that one class has certain distribution rights, a different class has different distribution rights. In that case, you're blowing up the S election, and you can cause your entire S election to terminate. So you're putting the whole thing in jeopardy by not following this particular rule. That's why it's very important. We see it commonly that after the fact, it's difficult to address. Typically, there are ways that it can be addressed, but it's good to avoid that altogether. So at the end of the day, if you're 50-50 owners, make sure the distributions are proportionate in that each owner takes the same amount as the other. So if one takes 100,000, the other one has to take 100,000. It's not a choice. It's not an election. It's one of the requirements of maintaining a single class of shares. All right, moving along. Number 4, failing to properly track shareholder basis. This one is always bad, but it's getting worse, and I'll tell you why in a second. But what is shareholder basis? Shareholder basis can be thought of as, quote unquote, skin in the game, right? If you buy into the S-Corp, you make $1,000 upfront investment, your basis is $1,000. Then if you have $1 million in income that's allocated to you as the shareholder, your basis increases by that million. Then if you take distributions, your basis decreases, and so on and so forth. Basis changes year over year. It's cumulative. You have to start at day one and track the basis from year to year to make sure that you always have a current figure. What do we see happening all the time with new clients coming in? Not only did they not track the basis, they have no idea what that even is. Huge problem, because if a S-Corp has been around for the last 28 years and nobody knows what the basis is, then those people have some explaining to do, because to go back and try to figure it all out can be a job in and of itself. The other aspect is that shareholder basis governs the tax treatment of amounts that you take out of the S-Corp. So if you're taking distributions and you have adequate basis, meaning that you have $1 million in basis and you take 50,000 in distributions, you're all good. But if your basis is at 0 and you take 50,000 in distributions, you may have a taxable event. So knowing that basis number is crucial in terms of determining the tax treatment of any amounts you take out of the S-Corp. Additionally, if you have losses from the S-Corp, your basis will determine if you can deduct those losses on the personal tax return. So if you have $1 million in basis, 100,000 in losses, you may very well be able to deduct that 100,000 on your personal return, offset the tax from wages, interest, and other sorts of income not directly related to the S-Corp. Can be very powerful. There are other limitations that come into play. There are a number of them. Basis isn't the only one. But if you have, let's say, 0 basis in the S-Corp and you have 100,000 in losses, that 100,000 is going to be suspended and carried over to a future tax year. So you can see how basis can be extremely important to an S-Corp shareholder. But if you don't know it, then we don't know how to treat the amounts that you take out. We don't know if you can deduct those losses. And when you go to sell your shareholder interest, the first question is, what is your basis? And the basis is compared to the amount that you sell your share for, and that's where the gain is. So if you don't have the information and, importantly, the substantiation, meaning the records, your basis is going to be assumed to be zero. So think about it. If you sell your S-Corp share for $1 million and you know that your basis is $800,000, you're only paying gains. Typically, there's a wide variety of treatments that can go into this, but typically you're paying the $200,000 gain, tax that's related to that gain. But if you don't have any records and nobody knows what your basis is, in some cases, they may assume a zero basis. So now you're paying tax on $1 million in gains. Big difference. And the only thing separating the two situations is knowing your numbers. Now, there was a time where you can kind of skate by not knowing your basis. And the IRS didn't have a clear idea of what your basis even is because it was a number that was tracked by your accountant on a worksheet somewhere in an Excel spreadsheet. It wasn't expressly stated on the tax return. So in many cases, if the S-Corp is making money year over year, it wasn't as much of an issue and you didn't have to include it on a tax return. So it wasn't the end of the world. It was bad, but it wasn't life ending. Allow me to introduce you to a brand new tax form. I know you guys get excited about brand new tax forms. Well, here's one for you to enjoy. It's Form 7203. The IRS realized that they have no idea what the basis is for a lot of the S-Corps out there. So they introduced this form this year. I know you're lucky to be here for this. We all are. But here it is, Form 7203. Look at this. S-Corporation shareholder stock and debt basis limitations. This goes on the personal return. It's required in many cases. Look at this. Shareholder stock basis. It starts by asking you the stock basis at the beginning of the corporation's tax year. A lot of S-Corp owners have no idea what that is. That's a problem. Because it's no longer a number that's tracked in some worksheet somewhere, some Excel spreadsheet somewhere in someone's basement by someone like me. Now, the IRS says, show us your cards. We want to know what your basis is because if you're deducting losses, if you're taking distributions, we want to know what the tax implications are. And we want to know that you know the tax implications. All right, so there's no more hiding. It's all out in the open now. And a lot of S-Corp taxpayers out there, a lot of S-Corp shareholders are going to have a lot of trouble with this line item right here because they have not been tracking basis. Now, there is a way to back into it and figure it out. Us accountants, we're slick in many different ways, and coming up with the basis number is one of those ways. It may not be all that easy, but we'll come up with a number for you. Because the worst case scenario is that your basis starts at zero. Can't be negative. But if you have no records, no clue, no idea, it's impossible to piece it together, then zero is where you start, and it may not be all that advantageous. You may miss out on significant tax benefits that you would have had if you track this from day one. So 7203 is here to stay, and it is a detailed little tax form. It asks about your debt basis. It goes into the different notes or loans that may be out there. All right. So it's 2 pages of goodness that will require S-Corp owners to be and stay on their game because this will need to be filed on an annual basis in many cases. So no more hiding in the shadows with regard to shareholder basis. All right. So that's why failing to track it is a huge issue. And a lot of times we don't know that the shareholder has no idea what their basis is until they sell their share, right? So you can imagine, hey, I sold my S-Corp interest for $7 million last year. What's your basis? No idea. Could be $1 million, could be $6 million. How much should they pay for their extension? Who knows? Becomes a crunch at the last minute. Good to avoid it. Okay, so let's take a look at deadly sin of S corporations number 5. Holding real estate in an S corporation. Well, on its face, it seems innocuous, right? Well, S corporation can be a business. Renting properties can be a business. Why not take those rental properties and put them in an S-Corp? Well, what does real estate tend to do? Real estate tends to appreciate, meaning the value goes up year over year. So a real estate property that you, let's say, contribute to the S-Corp when it's worth $1 million, a few years down the line can be worth $5 million. And you might say, at that point, I want to take that property out of the S-Corp, or I want to sell that property. What are we looking at? Well, if you want to take the property out of the S-Corp, guess what? You now have a taxable event. Whereas if you didn't have it in an S-Corp, you would not have to pay tax on the transfer of the property from the business entity to yourself. Let's say it was in a single member LLC. But putting it in the S-Corp creates that issue because there's a clear line of separation between the S corporation and the individual shareholder owner. By putting real estate in S corp, you're basically setting up that tax time bomb to go off when you start transferring properties back and forth. And in many cases, it's not advantageous to hold real estate in an S corp unless there's a tremendously good reason, in which many cases there's a better way to approach it. Okay, so real estate in S-Corp, you better have a great reason for doing that. Otherwise, you may be setting yourself up for a headache down the line, which comes as a surprise to many S-Corp owners because they think real estate is tax beneficial, S-Corps is tax beneficial. Combining the two, I get super tax benefits. Well, it doesn't quite work out that way. Number 6, incomplete accounting and bookkeeping. What are we talking about? Now, with S-Corps, I mentioned earlier on that there is the requirement to maintain books. It's a separate business entity. It's a different tax beast altogether from you. You can't just smush it all together and hope for the best, all right? It needs to be separate and distinct, separate bank accounts, books and records, payroll. It's a new level of responsibility above a single member LLC, for example. So I mentioned here that there's an exception to filing schedules L and M1. What does that even mean? Well, let's take a look at Form 1120-S. This is the U.S. income tax return for an S corporation. And you'll see here that on the front it has income, deductions, all that good stuff. Okay? And if we scroll down to the bottom of page 2, we'll see question 11. And it asks, does the S corporation satisfy both of the following conditions? Number 1, the S corp's total receipts for the year were less than $250,000, and since it's both of the following conditions, and if the corporation's total assets at the end of the tax year were less than $250,000. If yes, the corporation is not required to file schedules L and M1. What are schedules L and M1? Well, the schedule L is right here. It's the balance sheet per books. Okay, so you get to avoid filing this wonderful schedule. Okay, schedule M1 is right here. And you get to avoid filing schedule M1. So you don't have to report a whole bunch of information on the return that you would have if you didn't meet the criteria set forth in question 11. So people are crafty, especially business owners, and what do? They use this exception as an excuse not to maintain a balance sheet altogether, which is a problem for the reasons I mentioned earlier. These people basically report their income and deductions, and that's all they track. They don't track the shareholder basis. They don't track distributions. They're not running payroll. They're just reporting income and expenses. The problem is when the business grows and it no longer qualifies for this exception, then the tide goes out and we see who's wearing shorts, because now you have to report the balance sheet. Now you have to report Schedule M1. And if you haven't been tracking any of this information, how are you going to do that? That's the question. This is where a lot of companies get into hot water because they don't track the numbers from day one. And even with our clients that started an S-Corp with zero in the bank, zero income, zero anything, they're filing a balance sheet from day one, even if they meet these criteria. The reason being is that if you start it right from day one, you don't have to play catch up later on. And there's nothing more fun than realizing that you have to put together a balance sheet for an S-Corp that's been around for 15 years and they have no idea what an S-Corp even is. So they've been taking distributions, they've been adding funds to the business, they've been taking loans here, there, every which way. Good luck with that. That return's definitely going on extension. But the exception here is not to be confused with an excuse to not track the books. And all too often, S-Corp owners say, oh, I don't need to report it. It means I don't need to track it. Wrong. You have to track it either way. And my recommendation is, in many cases, to report it, even if it has all zeros on it. Put it on the return, because then you know, for tracking purposes, the numbers. And any other preparer that gets the return, they know as well. Because if I get a return for an S-Corp and Schedule L is blank and Schedule M1 is blank, well, now I need a good starting point. And before we even hit the ground running, I have additional work to do to try to figure out what the beginning balances would be that we would use for the balance sheet if and when we need to report it. But in our case, we report it every year for every S-Corp. So in many cases, clients are not a good fit for us because the work was not done up front and they decided to take shortcuts. So this is a big one. You have to do the accounting bookkeeping. With great tax benefit come great responsibilities, all right? And this is one of them. It is what it is, guys, but this is something that is crucial if you're going to step into the S-Corp world, all right? You're upgrading, you want some tax benefits, you got to earn it in many cases. It just is what it is. Moving along, let's look at the seventh deadly sin of S-corporations, and that's the failure to file S-corporation income tax returns in a timely manner. Now you might say, hey, I have a new business. I just started it. We didn't make any money. It's okay. I don't have to file a tax return. Let's just file my personal, call it a day. The problem is that the S-Corp has an annual filing requirement, regardless of income, regardless of assets. It's got to be done. And if it's not, there is a penalty that starts to accrue as soon as that return is late. And last I checked, it was a few $100s a month or part of the month that it's late, times the number of shareholders. So if you have a couple of shareholders, this starts to add up very quickly. It's not uncommon for us to do a first-year S-Corp return because the client came to us late. They didn't know that they had an annual filing requirement because the business is new. And that brand new business ends up costing them $2,500 in penalties, which in some cases we can get abated. We have to take a look. Things can be done in some cases, but we see it all the time with new S-Corps in that they feel that it's similar to their personal return, where if you have insufficient income, you may not need to file, even though we advise clients to file pretty much all cases. But with S-Corps, it's a different level in that there's an annual filing requirement, whether you like it or not, and it's irrespective of business activity. Alrighty? Again, a lot of administrative burdens that go into it. That's one of them. You got to file those returns, and it's a separate return to your personal. It's not all reported on, let's say, Schedule C. It's a 1120S for the S-Corp, and then you file your personal on Form 1040, typically. All right. Those were the 7 deadly sins of S-corporations. Those are the issues we see most often. But because I love you guys so much and I'm having so much fun here, I put an 8th item on the list because that's the extent of how people screw this up. I mean, unfortunately, there are a lot of different issues we see with S-Corp. But let's take a look at number 8. And if you're following along, see if you can guess what it is. If you work with S-Corps, I see a lot in my comments that you guys know what you're talking about. So can you guess what number 8 is? Let's find out. Number 8 of the 7 deadly sins of S-Corps is improper termination. All right. So in some cases, S-Corp owners reach the conclusion that it's not really right for them. For one reason or another, it doesn't matter the reason. But they reach a point where they go, I am better off without this. I want to close it. I want to shut it down. And I want to do something a bit more simple. Maybe go back to operating as an LLC, a single member LLC, so we don't have to worry about the payroll. We don't have to worry about all these different implications that I discussed earlier. So what that person will do is that they'll terminate their S election and make the mistake of assuming they're going to go back to single member LLC treatment as an example. But what happens is the way the tax code is structured is when you make an S election and you terminate the S election, your LLC, let's say, goes to being treated as a C corporation. Imagine the surprise on the taxpayers of clients when we tell them this. In that case, they think they're operating as a single member LLC. Meanwhile, they are a C Corp. What is one of the major downsides of C Corps? Double taxation. So this individual is thinking that they're taking distributions from the single member LLC. Meanwhile, they're taking dividends out of a C Corp. That can be a huge difference from a tax perspective, to say the least, all right? So there is a way, to be clear, to terminate an S election and still have that same entity taxed as a disregarded entity or a single member LLC as an example, but it's an extra step that you need to take that clients commonly forget to do because they have no idea that that's even an implication. Okay, so improper termination is one of the issues we see as well. And if you're going to terminate an S election, typically it's good to have an accountant involved to assess the implications of terminating it, because there could be some taxes due once you terminate that entity, and to ensure that once that S election is gone, that you have the proper tax treatment that you expected, because you really don't want to have single member LLC withdrawals be taxed as dividends, because you're going to have a bad time. Okay, so that was the 7 deadly sins of S corporations, what not to do. If I forgot any, let me know in the comments below. Let me know what situations you've run into with S-Corps, with clients that didn't do it the right way or that made a mistake, and how you resolved it. I'm curious to know your comments. Let me know down below. If you liked this video, if you enjoyed it, hit that like button, subscribe to the channel. There's going to be more content coming up, and hit that bell icon to be notified of future videos, because I know that a lot of you have not clicked the bell icon, and it breaks my heart. All right. So with that, I appreciate it as usual. Thank you guys so much for the support, for all of the great comments, for all of the great questions. And I will be back soon with another video. Hopefully this was helpful. Thanks for watching.